Hey everyone, welcome back to Chip Stock Investor. It's Nick and Casey again, and we look ridiculous. I didn't know you were wearing that shirt today.
This looks like a clothing sponsorship or like we are Team CSI uniform going on here.
Well, today we're Team CMP. Shout out to CMP.
Yep, free promo. Not paid to say that. Maybe we should actually mention who we are promoting today.
The sponsor of today's video is actually Pickle.ai. Great partners for us here at CSI. You see a ton of their charts in our videos. They're integrated into our research platform, and you can get 15% off any paid plan. They've aggressively decreased the price of their pro plan, so you can get 15% off even that plan. Check it out, fiscal.ai/CSI.
And you'll see a number of those charts today when we're talking about Intel. Before we talk about the fiscal charts, here's a Nano Banana slide. Nano Banana was misbehaving, and there were no number of prompts to get it to report the right free cash flow. I think this is maybe reporting adjusted free cash flow, an adjustment to an already non-adjusted GAAP metric. You probably have already seen this 1,000 different places on social media at this point. Intel's Q4 was ahead of their guidance, but still not great. Revenue down 4% year over year. Earnings per share down. Gross margins down, which we'll talk a little bit about why that is today. Also, most importantly, the sequential guidance for Q1 2026 not being great either. The TLDR, I guess, we don't own Intel, and this is going to be a multi-year turnaround story. So we're not super concerned about the stock price. If it keeps going up for some reason after this, we'll live with it. And congrats to everybody that made some quick bucks off of Intel the last few months. Nicely done. Let's talk about one of the big reasons why it did run up in the last few months. This slide from Fiscal on the balance sheet highlights explains a big reason why.
And we have this broken down into total cash equivalents in blue. Their short-term debt is the little orange bar, long-term investments in purple, and long-term debt in red. So they've been able to pay a little bit of this debt down over the last couple of quarters. They've had a nice influx of cash from the US government as well as from Nvidia. But
the balance sheet is a big reason why the stock has rallied. When Lip Bhutan, or LBT's first goal as CEO, was to fix the balance sheet, let's say mission success on this. The balance sheet is in much healthier shape than it was.
Let's take a look at another fiscal chart. This is their operating cash, capital expenditures, and free cash flow. Cash from operating activities in blue, capital expenditures in orange, free cash flow in green.
Not positive free cash flow because they were still operating at a pretty sizable loss in the first half of 2025. Full year 2025, still negative free cash flow. But yes, the last 2 quarters, they turned the corner.
Their capital expenditures on the year, less than last year, but still not exactly what we would expect.
Yeah, we called this out in our little Intel pre-earnings update. What we were looking for was some signs that the business is recovering in profitability, not just because they've been cutting the CapEx expense. Compared to last year, big cuts in CapEx, although they did increase it in Q4. You can see almost 3.5 billion in CapEx, up from 2.4 billion last quarter. But the decline in CapEx over the last few years is really what has driven the return to free cash flow profitability. That's important when we start talking about the guidance for Intel. And you can see here the revenue expected to be down at the midpoint again, year over year, gross margin expected to be down, and earnings per share expected to be down on an adjusted basis, both gross margin and EPS on an adjusted basis here. Obviously, Intel was bleeding cash. They needed to fix that problem. So LBT, again, mission success on that by cutting the capital expenditures. But this is the problem because now the narrative has shifted to Intel is supply constrained. They can't get enough product out the door. And yet at the same time, the revenue is still trending down. They said it would improve through the second half of this year, 2026. But I think we need to go back and focus less on Intel and talk more about how the semiconductor industry has evolved over the years and why that is a big problem for Intel. I know this is a mess. We're going to look at our semi-industry flow. The industry, especially a few decades ago, really started to specialize. And in particular, we're going to highlight the middle layer there, the design and manufacturing layer of actual product. That's what gets reported as end market sales. When an IDM or a fabless designer reports a sale, that's where you'll hear things about we're headed towards 1 trillion in end market sales in 2026. That's coming from the IDMs and fabless. But what happened here is the old IDM model of designing and manufacturing everything in-house split into two separate segments. You have now companies that only design, fabless companies, and their foundries, their third-party chip fab manufacturers. This would be like Nvidia and TSMC, or AMD and TSMC. If you want it a little bit simpler, the research dashboard, just illustrating how the IDM model shifted. The fabless designers move upstream a little bit in the supply chain, and then the foundries supplanting a lot of the IDM manufacturing capacity in recent years. Why is that a problem for a company like Intel, especially right now when suddenly there's demand for their products again? That's a fantastic problem, right? Why is the revenue suddenly going to shrink again in Q1?
Yeah, theoretically, this is a fantastic problem for Intel to have. Customers want their chips. However, they've been having to shift focus in too many directions. They want to be an IDM as well as a foundry company, plus they're working on designing their own chips, leading edge chips. It's a lot going on. And you can see that illustrated a little bit better here in this chart from fiscal Intel revenue versus their manufacturing, maintenance, and growth, CapEx, versus their operating expenses, which would include design. So capital expenditures, they've been cutting. As we mentioned before, that's the orange bar on a yearly basis, 14.6 billion in the year ended December 2025. And then in yellow and red, we have SG&A in red, research and development in yellow, and then their total revenue. So total revenue continues to go down. They've had to remove some of that spending to develop their own chips. They initially were trying to spend more money to build up their foundry business. Now they're trying to shift that money back to their design work.
Yeah, and it illustrates why decades ago, really forward-thinking companies decided, you know what, we're only going to focus on one or the other. The island of Taiwan focusing on manufacturing, and then a bunch of fabless chip designers, and especially in California and Silicon Valley, deciding to do the design engineering work. It's expensive to do both. And the cost of doing one or the other only continues to rise. This puts Intel in a pickle because they're having to try to balance both, and they don't have the resources to try to do both. This is a problem that all the IDMs have been facing. We've talked plenty about this in light of Intel, but also the other IDM businesses too, the ones that focus on more mature manufacturing as well. Your microchips and Europe's IDMs, Japan's IDMs, even on more mature process nodes, it's very difficult to do both design and manufacturing. And especially when you have a constant army of newer, more nimble businesses that are fabless, designing their own products, and their partners, especially in Taiwan and Southeast Asia, with new dedicated manufacturing foundries popping up all the time that are focusing on just one of those two problems and do really well at one or the other. So it was a difficult spot for Intel. And now, like you said, Casey, over the last couple of years, they've been cutting the CapEx because the demand for their own internal products and their foundry business wasn't there. So they cut the CapEx, focused on product. Now companies, their customers want product. Congrats, you designed something that's in demand again, but now the capacity is not there to actually manufacture it. So frustrating if you're a shareholder, but these are not really new problems. These are not a surprise. This is just how the semi-industry works now.
Let's walk through some comments from the CFO, David Zinsner, and try to figure out what's going on exactly. This first one, talking about segment results, this is Intel Products Q4 revenue up 2%, 12.9 billion. Client down 4% quarter over quarter. And AI PC units grew 16%. Data center AI up 15%, as Nick said, reflecting that demand now versus their legacy chips. But he's talking about their balance of supply constraints. So what's going on here? As he mentions at the very end, it says, where possible, we're prioritizing our internal wafer supply to data center and leveraging an increased mix of externally sourced wafers and clients.
Yeah, because they now no longer have the capacity to manufacture everything their clients want. They're having to rely on external sourced wafers like TSMC for the client, for PC chips, and utilizing what they have right now for the data center business internally. A continuation of that quote, just illustrating the problem right now, because this has now been circling around the media for about 3 months. The CPU capacity is supply constrained. This is not the same type of shortage as like the memory shortage going on, or even the GPU shortage. This is simply Intel not having enough capacity for this current growth cycle that has finally arrived. So if they had the capacity, if they had been able to build it the last couple of years, Zinsner says revenue would have been meaningfully higher if we had that more supply. There's a lot of talk here about CPUs still very much a thing for AI. Of course it is. There's CPUs in a GPU-based accelerated computing system. That doesn't mean there's this massive shift back to traditional CPU-based servers. That just means CPUs are still a very important piece of the whole computing pie. What is actually happening here is they do not have enough capacity. So this is not really a demand-driven shortage. This is more of a lack of supply-driven shortage. We talked about this a number of times last year. The CPU business is not just getting dented by GPUs, it's getting dented by something else as well. And I think this part of the quote is really meaningful here, the second half of this slide.
Okay, it's talking about custom ASIC revenue. What an ASIC is, why companies would want an application-specific integrated circuit, aka a Google TPU, but their business in this market grew 50% in 2025, 26% sequentially, and reached an annualized revenue run rate greater than $1 billion in Q4.
$100 billion TAM.
Well, exactly. It's a very small piece of the pie.
Mm-hmm.
But it does make sense that this is the part of the business that would grow more rapidly.
Yeah. So supply constraints on CPUs and all sounds great, but this is a dual headwind going on as the market shifts out from under Intel. This is a great benefit for Broadcom, who does the co-design work with Google on those TPUs, supplies a lot of the IP. So now we flipped back again. You said they're having to make difficult decisions, choosing where to allocate their resources. They've been focused on design the last few years, operating expense. Now we're shifting back to CapEx again because they need more capacity. We'll walk us through this quote here from Zinsner again.
Previously, they said that capital expenditures for 2026 were going to be down, but now they're planning for a range of flat to down slightly, and for expenditures to be more weighted in the first half. And he said, as a reminder, the CapEx in 2026 would be to support 2027 and beyond.
It's just a tough spot. They basically don't have enough resources to really fix the supply problem. And in the meantime, other companies are going to take that market share. If Intel can't supply it, someone else will.
Yeah, where do we think that they're going to be in a couple of years from now? Once their CapEx is spent, we've got the manufacturing facilities in place. Will it be too late at that point?
Yeah, this is why for years now we've been saying this business really just needs to make the hard decision to split in two. For everybody that thinks Intel Foundry couldn't survive on its own, that's what investors are for. They've found quite a few investors keeping the business together, limping along like it is. I think they could have found some investors to help prop up Intel Foundry business, focused solely on manufacturing capacity. But that ship has sailed now. They've decided they're going to keep it the same. All right, fine. Where are they going to be in a couple of years? It's hard to say, but this is going to continue to be a problem where they have to constantly go back and forth on making hard capital allocation decisions on the business because they just don't have enough profit from their sales to do both. And then because they don't have enough profit to do both, the business continues to struggle. It's kind of one of those vicious cycles. I think we wrote a couple of years ago about why price to book values are not very good with tech businesses. They get into these death spirals. It's catch 22. A couple of years out, though, where are they going to be? Well, things right now, demand is looking good for Intel 7, Intel 3, and Intel 18A. What about 14A? Here's just one more time illustrating the conundrum. And this is when some of the hard questions start getting asked on the Q&A portion of the call. 14A being the next manufacturing process after 18A.
We'll focus on the bottom part of this slide first, and then we'll talk about the good news. This is again from the CFO. On 14A, he says, Lip-Bu has been very direct with us on all of this. He does not want to spend on capacity on 14A, only spend on the kind of TD spend or R&D spend associated with 14A. So he's saying they're not spending on actually building that out, but just on the design work.
Yeah, they do have some manufacturing capacity for 14A to help support early client engagements. But if those client engagements go really well, and there's enough there for the customers to say, we're ready to move forward. The problem is there's no capacity to go to mass manufacturing right away. By the way, I think I know where you're going with the good news here. If 14A does take off, who's going to make some money from this?
Who's going to make some coin?
First, we have to focus on like maybe getting those customers to say, hey, we're going to commit to Intel 14A. If they do, what does that mean? You win on the design side, the product is ready. Now what?
Now you have to make it in mass. And to make it in mass, you're going to have to spend money on the manufacturing tools, Fab 5. And you can focus now on the top part of that comment. According to them, they have a good footprint as far as the clean room goes, but they need to devote more of their spending on tools in 2026 in comparison to 2025. Now, you may remember in a number of our callouts this year, companies have been really affected by Intel not being able to spend money like they normally do on tools.
Yeah, the tool companies, especially the first half of 2025, before the market woke up after the summer break and realized, hey, these guys are probably going to have a good 2026. They might have a really good 2027 as well if Intel can deliver on these new customer engagements. Synopsys obviously got hit. Intel historically a pretty good sized Synopsys customer. Just tough resource allocation decisions that also trickle down to revenue problems, profit margin problems. But at the very least, the good news is it looks like there's progress being made. That's fantastic. And the balance sheet is in much healthier shape thanks to some new key partners stepping up to the plate in SoftBank, Nvidia, the US government, selling some more of Mobileye stock, selling the majority of Altera, divesting that. So that's great. But the problem is now that there's capacity constraints, who else wins besides potentially more equipment sales later this year and into 2027? Who actually has capacity right now?
Yeah, AMD. They have the designs, they have the customers, and they're fabless. So they're getting those chips made at a company like TSMC.
Now, of course, they'll have to compete for that capacity at TSMC. But TSMC has said it's ramping up its CapEx in pretty modest fashion this year and probably into next. So very much not resource constrained when making decisions to expand their manufacturing footprint. I think long story short, what we're saying here is Intel at least has stabilized. Not one we're interested in owning though, but I think this is more opportunity for Intel to pick up market share because they have the product ready to go. And if customers want product and they can't get it from Intel, AMD probably is going to have the CPUs ready for them. Last April, after the really big drop at AMD during the tariff tantrum, we said, great, valuation looks good again. And then obviously a lot of other items ensued, boosting AMD's business throughout 2025. And I think we're holding pat with that outlook. We're still moderately optimistic on AMD. We like TSMC. We like Broadcom. We like Nvidia. We like the Fab 5.
I see that you slipped in one of your slogans at the end here. There are no moats in software or in hardware, only fastest cars.
That's why Warren Buffett doesn't like investing in this industry in tech.
It's a fast-moving industry.
Yeah, you have to spend the money. You constantly have to be on the move. or you're going to get left behind. I think moats are a cliche anyways, but especially in tech, it's just not the right mode of thinking when you're thinking about investing in fast moving technology. It's not a moat. You're constantly having to keep up with shifts, potential shifts, and you got to spend money. You just got to do it. The engineers have got to get paid.
Go get that bread. Thanks everybody for watching this episode of Chip Stock Investor. Make sure you check out fiscal.ai/CSI to get your discount, and check us out over on Semi Insider, chipstockinvestor.com.
Yeah, see ya.
See you later. Take care, everybody.